Welcome to this week's update on the hedged option portfolio. If we take a look at the price action since our last video, we can see there was an increase in price, which was quite good for our short puts. As you'll see, our equity went up quite a bit, but then it came down a little bit again with this dump that we've had in the last day or two. If we go and look at the account, at the end of the last video, we had an equity of 0.266, around about there, and now it's at 0.269, so it is up a little bit at least. If we look at P&L analysis, should go to now, we can see that we are higher than last week, but it was even higher before we had that price dump. If we look at the current positions, we can see that in fact, I'm going to look on the visualization I've got here because it's easier to see what we've got and where. Still got the same long dated cover, of course, and the same stuff in September. But if we zoom in a little bit, we can see the shorter dated stuff. So most of our current worries are around the 30th of August expiry. And we've got several short puts that are in the money here still. Now, what I did do earlier in the week is close some of the short puts we had here and bring them forward, and they expired this morning. Unfortunately, they expired in the money by quite a bit, so I've had to roll that one out over to here. The next weekly expiry on the 6th of September. So most of what we're doing at the moment is basically just waiting for these positions to expire, because this is where the bulk of our exposure is at the moment. Either these short puts will expire in the money, in which case we'll roll them out, or they won't expire in the money. We'll make a profit on them, and then we can just start selling our regular short-dated stuff. If we go back to the account, the 30th of October is actually the expiry I would typically open more positions on now, because it's the 28th. But as you can see, on this expiry specifically, we already have quite a few positions. We've got 3, or 0.3 I guess, in the money puts, and 0.1 out of the money calls. So obviously by Friday we're kind of hoping for a little bounce here. If it expires where it is, it's not too bad. We can just roll these, but ideally we'd like it to expire in here somewhere, so all this closes off at full profit and we can just continue as normal. But as I've already got positions on this expiry, I don't really see the need to open more. If we look at the bottom, we can see the delta is positive, which is what I want, and the theta is positive, which again is what I want. So I'm happy to just hold this into Friday's expiry and basically see what happens. I did consider rolling the 63k call down to maybe 61 or 60.5 this morning to collect a bit more credit, but I decided to just hold what I've got until Friday and then reassess. As we're not going to place any trades today, I thought I'd use today to take a quick look at the portfolio margin page, which we can get to by clicking this. We can see our margin usage right now is very low, it's well under 20%. And the main reason for that is all of our short puts or short calls, everything's covered several times over in most cases. So even if we get a big move in some direction, the account's going to be totally fine. And the portfolio margin system does take account of that. So I won't cover all of these parameters because that could be a mini series in itself. The entire calculation's quite involved. But I'll cover this risk matrix underneath because this is quite useful to know. So I'll just give a quick overview of how to read this risk matrix and how it can be used to think about how your margin requirements relate to what is contained in your portfolio. For those not aware, if your account is set to use one of the portfolio margin models, the margin system calculates your margin requirements by looking at how your entire portfolio would perform in various price and volatility scenarios. And each of the columns here in this table is a different scenario that your whole portfolio is tested against. You can see the individual positions listed on the left, and each of these columns is a different scenario. So I'll start in the middle here, and 0 represents that there's been no change in the underlying price, but we still test the portfolio against a drop in volatility, which is the down arrow, and an increase in volatility, which is the up arrow. So you can see here, if price just sat still but volatility increased, then our portfolio would gain value. And the primary reason for that is that we're holding more options than we've sold. And then each of these numbers here, we can see -1 here, -2, -3, -4. Those are price buckets. And to know what percentage those represent, we can check the table underneath. We can see the price range for Bitcoin is 16%. And that price range represents -4 to 0, or 0 to +4. So each of those is 16%. So this entire range is 32%, -4 being -16%, and +4 being +16%. So going back to these columns, if we look at -4, for example, that represents a 16% decrease in the underlying price. And the middle column under the -4 is just the price decreasing by 16% and volatility remaining exactly the same as it is now. And the down arrow represents a -16% in the underlying still, but also volatility decreasing. And then obviously this one is for volatility increasing. So our portfolio is tested against each one of these scenarios, and whichever one is the worst performing scenario, that's what's used to calculate our margin requirements. And because each scenario contains all of the positions in the portfolio, a hedged portfolio will often have considerably lower margin requirements than an unhedged portfolio. And by a hedged portfolio, I just mean one that has different positions that at least partially offset each other's risk. And we can see for our portfolio, that's clearly the case because we have lots of short puts here, 0.3 here, and then we have long puts further out. So obviously the risk of these two positions at least partially offsets each other, and that will be taken account of in the total at the top. The worst scenario in our portfolio here is the -3 bucket, which represents a 12% decrease in the underlying price, and combined with that, a drop in volatility. So if the underlying price decreases by 12% and volatility decreases, then that's the worst possible scenario for our current portfolio. And if we think about what positions this portfolio consists of, we can see why this would logically be the case. We're short several short-term puts that are relatively close to the money, and even in the money in some cases. So a drop in the underlying price would result in a decent-sized loss in these. But to cover these against any tail events, for example, price dropping 33 or 66%, as these columns look at, we're holding longer dated, much further out of the money puts. So if the volatility level drops dramatically, these much further out of the money puts would not pick up as much value as they otherwise might. And they could even lose money if the price move isn't too large. This means that a moderate move down, combined with a reduction in overall volatility levels, would possibly result in most of our positions losing money at the moment. If the volatility also increased on such a move, so that would be this column, our oversized cover would then likely make up for the losses on the shorter dated puts. And if the move was very large, dropping all the way to the strikes of the cover or even past that, so we'd be looking at this -33 or -66, which would be well past all of our strikes, then the gains on the cover, which is currently oversized, would actually start to outweigh the losses on the short-term puts. And one more thing I'll cover is we can see the numbered buckets here, -4 up to +4. These are the ones that will be used to calculate the bulk of your margin requirements. The percentages either side, that's the extended risk matrix. So -33 and -66 here, and then 50% up to 500 on the upside. The whole of those values wouldn't be used to calculate your margin requirements. We would just use a percentage of that if it's very negative. Basically, these huge moves are just designed to catch any outsized positions that you've got that are currently quite far away from price, but would dramatically impact the performance of your portfolio. So if you'd sold a ton of very out of the money calls, for example, like strikes of like 200,000 or something, the normal risk matrix isn't really going to capture the risk that you're holding there. But the extended risk matrix would. And in that case, if you'd sold, 1,000 very far out of the money calls, or whatever size would be large for your account, you might not have collected much premium, and there might not currently be a lot of risk. But if the price pumped 200%, then you can bet your margin requirements would increase dramatically. So this extended matrix takes a little bit of that into account now, just to stop you holding too much risk. But at the moment, that's not really relevant to us, because we're buying further out of the money and selling the at the money and slightly out of the money stuff. And we can see this column here, the minus 0.0467, that's currently our worst case scenario. You can see in the total row, and that is what's being used up here for our margin requirements. So that's where that comes from. You can see the price must be dropping a bit more, and that's going to leave us at roughly the same equity as the last video, which is a neat place to end. You can see the price is actually slightly lower than it was last week when I made the video. So yeah, I didn't really have a trade to place today, so I thought I would use the time to cover another topic. So that's it for today's video. Thanks for watching, and I'll see you next time.